What's going on, good people? Welcome back to another episode of the Trading Challenge. Today is day number 14, April the 27th, 2023. We made some trades today, so let's get into it. So, coming into today's session, my goal was to be patient enough to wait for my best setups and to trade my best setups properly. So, that was my main focus and my main key going into today's session. So, let's start our analysis in the pre-market because we had a decent little downtrend coming into the market open. But when the market opened, we had one last candle to the downside, and then pretty much that's where we established the low for the day. And throughout the rest of the session, we saw prices move up in a very strong uptrend. So let's take a look at how that uptrend started and why all of these higher lows are going to be important for us. So once we created this low, we pushed up, created our first higher low for the day. Off of that higher low, I drew this support line from the bottom of the wick and extended it throughout the rest of the session. After that, we created another higher low. So we have two higher lows back to back. That's telling us that the buyers are strong in that specific moment. Now look at this green candle right here. This green candle was a retest of the higher low that got established before. So that's good. When you're in an uptrend, you want to see higher lows get retested, and you want to see prices bounce off and continue moving higher once they retest those higher lows. So we pushed up, created a new swing high, and pulled all the way back to the trend line. But look at where we tested. We came back to retest the wick for that first higher low. So that right there is textbook market price action. When you have an uptrend, you want to see all of the higher lows get retested, and you want to see prices find support when they retest those higher lows. And if that's able to happen, that tells you that the trend is strong and that the buyers are definitely in control. So once we bounced off the trend line, we pushed higher, created another higher low that also coincided with another touch of the trend line, and then we moved higher from that point, which led me to trade one. So let's talk about trade one. Let's read the trade notes. So I went long after a higher low was created during the uptrend. My entry was late, which eventually led to my break even stop being hit. Now let's talk about late entries in the trend and how they can sometimes go your way, but sometimes they can go against you. So when I saw this initial higher low get made and this touch of the trend line happen, I knew that I needed to get long. So my idea was, let me find what prices are important around this area. So if we zoom back out, we can see that this whole junction happened not too far away from the 33,550 level. So I'm thinking that if I know that the 50 level is always, no matter what market you're in, no matter what day it is, it's always an important level. So if we can break past the 50 level and stay above it, I'll go long as close as I can to 50. Preferably, I was looking for 49. Now here's what happened. Prices they dipped down below 49, got right back above it, and they stayed above it, which is where I should have went long. But I hesitated and I was like, is this really where I want to go long at? And then prices just moved away from it immediately, and I was like, dang, yeah, I should have went long. But I ended up chasing prices higher, and I got in at 58 instead of getting in at 49 where I should have been. So that's a 9-point difference, which can make a big impact on how your trade works out. And let's talk about that. So when my trade moves a specific amount in my favor, I automatically move my stop up to break even. That's mandatory. I have to. So whenever my stop is moved to break even, I will never, ever, ever move it back down and increase my stop. If my break even gets hit, that's just something that I have to live with. And that's exactly what happened on trade one. But look at where my break even stop was, and look at where the bottom for that candle was. The wick for that candle literally hit my stop, and then prices moved up and continued on without me. So I can't blame my break even stop in that scenario. I have to blame my late entry, because if I would have entered 9 points below at the open of this candle where I should have originally went long, prices would have never came back to my break even, and I would have been able to hold the trade from here all the way back up to my profit target, which would have got me out somewhere up here. So that's just a little small detail that made that trade go wrong. And I didn't lose any money on that trade, but I also didn't gain any money. And I feel like My entry was legit. My trade was good. I traded in the overall direction of the trend. But because of my bad trade management, I ended up not making anything. So that's just one of the small losses, not losses, but one of the small details that I want to work on and clean up. So let's continue on and let's talk about trade number 2. So after we pushed past trade number 1, we created a new higher low right there, pushed up, made a new swing high, and we pulled back. Now what I started to see right here was I started to see a series of consecutive candles that were all green. So we had 1, 2, 3, 4, 5, 6. Up until that time at trade 2, we had 7 consecutive green candles. So my thought is, if we've already had higher lows, that shows us that the buyers have clearly shown that they are in control of the market. So we know that the trend is up. That's non-debatable. So if we're at the highs for this potential swing, are we more likely to pull back after we had 6 consecutive green candles, or will we just continue moving higher until we reach some type of major level of resistance? So I opted for the latter, where I thought that prices would continue moving higher. And this is actually one of my favorite setups, which I call a continuous bull spike. So in a continuous bull spike, if you guys remember from yesterday, actually let's bring up that chart. So yesterday we talked about a continuous bear spike where all of the candles are red. Well, in this scenario today, we talking about the exact opposite, a continuous bull spike where all of the candles are green. So in continuous bull spikes, you actually look for your pullbacks based on the wicks of the candles. You don't really look for multi-candle pullbacks because they're very unlikely in a spike. More than likely, the candle spike will have a long tail wick, and that will be your pullback. So the pullback happens within the candle. So let's actually go to our records and let's break that down a little bit and talk about it and give a little bit of detail. So this is an example that happened this morning during the London session at around 3 o'clock. So let's read these notes. This bull spike, continuous bull spike, offered one multi-candle pullback at points A and B. So you had a pullback right here, but notice how even though the market pulled back, none of the candles closed red. Still, they weren't able to close red. So that tells you that even though it was a pullback, the buyers were strong enough to make sure that none of the candles turned red. They might have closed as a doji, but the buyers made sure that they did not close red. So that's very significant, and that shows you that you didn't think the buyers were in control. Now you have pretty much no doubt. So let's look at the rest of the notes. Also take notes of how candles 1, 2, and 6, they all closed off of their highs. So this is candle 1, candle 2, and candle 6. Look at how at one point in time, candle 1 was a completely green candle with no wicks, but then it pulled back and it closed near the midpoint range of that candle. That was your opportunity for a pullback. Notice how the same thing happened at trade 2. At one point in time, it was a completely green candle, and then it pulled back from its high and closed near the midpoint range. That was your opportunity. Same thing on candle number 6. Prices were a complete bull candle, and then they closed significantly off of the highs for that candle. That right there is your pullback. So when you have a continuous bull spike, remember that you want to look for the pullback within the candle and not necessarily a multi-candle pullback, because even though it happens like this in this scenario, it's usually not the case. Because if we go back and look at other bull spikes, we have just complete green candles, no pullbacks, well, no multi-candle pullbacks. Same scenario here, same scenario here. Another example, this one is really good, this one is nice. Same thing with this. Look at that wick right there. That was your opportunity to get in. That was the only pullback that this particular continuous bull spike gave you. So we have a lot of instances where this happens in the market, and it happens pretty often, actually, more than you would think. So that's what I was looking at going into trades number 2 and trades number 3. Now let's talk about trade number 2. The reason that I closed this trade early was because, well, let's read the notes first. I went long after another higher low. I scratched the trade when it turned negative by a few points, because if I'm going to go long at higher prices, I want the trade to immediately go in my favor. And if it doesn't, I close the trade immediately for a little small loss rather than watching it move down to a pullback area and then continue up, and I have to take that full stop loss. So I'll just cut it for a smaller loss. And then if prices spike back up through my original entry, I'll get back into the trend. And that's exactly what happened at trade number 3. So I took the same entry from trade number 2, but this time I held that trade all the way up to my profit target 20 points higher, and that's where I exited the trade for number 3. So let's continue moving on. Once we got done with trade number 3, we saw prices continue higher for 3 more candles. So this actually ended up being a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, an 11 candle bull spike, an 11 candle continuous bull spike. So that's very significant. If we didn't think that the buyers were in control before, now we have absolutely zero doubt. So once we got up to the top of this swing right here, we pulled back, created a higher low right here, and then we came back up to make what we could call a double top, a little minor double top, but a double top nonetheless. Off of that double top, we created a lower high, and then we pushed down. Now once we pushed down, let me zoom in a little bit. Now once we pushed down with this red candle right here, that's where I created my zone, because we had 1 touch, 2 touch, 3 touches, 4 touches. Once we had that 4th touch, that's when I draw my consolidation zone. So right after I drew that consolidation zone, I saw prices start to bounce up on that next candle. See how this candle had a wick? So did this one, had a long tail wick on the bottom. To me, I'm looking at that as bullish momentum. I'm seeing that the buyers are stepping in right there. So I went long in anticipation that prices would move back up to the top of the consolidation. Now they eventually did that, but not initially. I got in a little bit too early. So let's read the trade notes for trade 4. I went long at the bottom of the zone. I expected it to hold up, but I placed my trade before I took time to make a reasonable decision. Now that's how I felt in the moment when I wrote up the trade notes, but looking back on this trade, I keep trying to find a reason to say that I shouldn't have got into this trade. But sometimes, man, when you see your setup, you trade it the right way, sometimes it just won't work, and you try and find a hundred different reasons as to why you shouldn't take that trade the next time, but I can't find a reason. I had a consolidation zone, prices came back to the bottom, and I went long. So when I see a consolidation zone, my strategy is first identify the direction that prices were moving in before the zone occurred. So we can see that prices were in a clear and established uptrend before the consolidation. So once the consolidation got occurred, I identified that the prices were moving up. That tells me that I only want to do one thing. I want to go long within this consolidation zone. And if I'm going to go long, I need to go long from either the exact bottom or somewhere very close to the exact bottom. I think trade 4 fits into that category. I went long, not at the exact bottom, but very close to it. So I would say if I saw this scenario again, I would have to take the same trade because it fits my setup perfectly to the T. I can show you numerous other charts where this same setup worked perfectly for me. It's just that this time it didn't work. And that's one thing about the market. You know, you might have a strategy that's been tested and that you believe in. Sometimes you take your best setup and it just doesn't work. But if I had to take that trade 100 times, I'll take it the same way on each occasion. So let's move on to trade number 5 and let's talk about that. But actually, let's talk about what happened in between trades number 4 and 5, because we see these notes down here that said we had a breakout retest that failed. So notice how we broke out past the zone, we closed below the zone, had another candle that closed completely below the zone. So that right there is a breakout. We came back on this green candle to retest it, and then we started to move away. Now I think it's very interesting how sometimes in the market you can see the same type of setup, but you can see different variations of it. Because if we go back and look at what happened yesterday, so this is yesterday's chart from April the 26th. Notice how we also had a breakout yesterday from the bottom of the zone. We broke out past the bottom, came back to retest it, started to move away, and had a double top retest, and then eventually moved away, and the breakout retest was successful. But notice how today we broke out past the bottom of the zone, came back to retest it. But unlike yesterday, the breakout failed. It was not successful because prices pushed back up into the zone after they made a higher low. Notice how this circle right here is a higher low in comparison to the low that was made for the swing that broke out past the bottom of the zone. So once we had that higher low get established and we pushed back into the zone, that's where I went long, and pretty much at the same price that I did from trade 4. The only difference in this scenario was that the market gave you clear signs that making a move to the upside was more likely than not. So let's read the trade notes for trade number 5. I went long after prices made a higher low and pushed back into the zone, and then I exited at the top of the zone. So I just simply followed my strategy for trading consolidation. Identify the direction before the consolidation was established. That was up, so I'm only looking for long trades at the bottom of the zone. If I take a long trade at the bottom of the zone, I'm looking to get out at the top. Now, yes, prices did push past the zone and continue moving higher, but for me, I had to stick to my plan. When I'm trading a consolidation, I know that most of the time the consolidation will hold until it's a clearly established breakout. And most breakout attempts will fail. And if we look at the market, notice how we tried to break out to the bottom of the zone right before trade 5. And then right after trade 5, we broke out past the top of the zone. So a lot of times in the market will show you what it wants to do because it's done it already. In this scenario, the market tried to break out past the zone on the downside, of course, and it failed. Then it tried to break out on the upside, but it failed. So the market was already showing you signs that this breakout might not have actually came to fruition, at least not at that point in time, not yet. The market was not ready. So I just think that's very interesting. I could have held that trade, but I prefer to follow my plan because most of the time a consolidation zone will hold up. So that's why I took my exit at the top, and I'm glad I had enough discipline to stick to my plan, because in this scenario, going against my trading plan and continuing to hold the trade, it would have worked. But let's talk about, or what about all of those other times where you continuing to hold your trade doesn't work? So you got to find what rules you want to follow in the market, and you have to stick to them, even if sometimes you could have had more. It doesn't matter. You take what you can get. If your textbook said, well, if your trading plan says get out at the top of the zone, that's exactly what you do. But speaking about similarities in the market, I have one more that I just realized. So notice how today we had a continuous bull spike to the upside. Look at how yesterday we had a continuous bear spike to the downside. So it's the same pattern, but just flipped upside down on different days and different trends. Yesterday was a downtrend, so we had a bear spike. Today was an uptrend, so we had a bull spike. I just think that's very interesting how the market just repeats certain patterns over and over and over. But anyway, let's continue on with our analysis, and let's move back to trade number 6. So before we get to trade 6, once we were talking about that failed breakout up here, look at how prices pushed back to the bottom of the zone, well, to the top of the zone. Right here, this is where the potential breakout retest should have succeeded. But because it didn't, and it made a lower high, even though it's a small lower high is still a lower high. So after it did that, we pushed back down into the zone, came back up to retest that zone one more time, and created another lower high, which is where I drew this minor bear trend line. So let's talk about trade number 6, because when prices got back up to the top of the zone, I really did consider going short somewhere around 38 or the 37 price level, 638. Now I knew that we had made a higher low before. We made a higher low right here, and we had a bearish trend line. So everything said to me, Ty, the breakout was a failure, and now we're retesting the top of the zone. We're more than likely probably pushing back down to the bottom. But I hesitated, and I was scared to get in because I just wasn't too sure that I should go short against the overall uptrend. And then prices moved down to close to the bottom of the zone. So let's zoom in and see exactly what I mean on this red candle right here. Now, when they were unable to touch the when they were unable to touch the bottom of the zone on that red candle, I assumed that more than likely we'll probably pull back up to the trend line and then actually touch that level. And that's why I went short on trade 6. So let's read the trade notes for that one. So it said I shorted in expectation of the bottom of the zone being reached, but I felt uneasy about the short trade during an uptrend. So I closed my trade early for a minimal gain. And I think that was the right decision by me. Even though that trade did work, I just don't feel like it's the best setup to go short, first of all, against a strong uptrend. Now, of course, I'm not just going to say that you can't make money on the short side during an uptrend. You can, but the probabilities are just greater if you trade on the long side rather than the short side. And if I was going to trade the short side, I should trade the short side from the highest possible prices that I could have got, which would have been up here at 38 where I initially wanted to go short at. Now, me going short at trade 6, honestly, that was me chasing the move a little bit, because if we're in an uptrend and you want to short a pullback to the downside, you want to short it at higher prices because your probabilities at lower prices just decrease. Now, of course, this trade worked for me. Okay, I got lucky on this one, I'm not gonna lie, because let's say that I went short one candle later, I would have never been able to make that profit, and I would have took a big fat loss, and I would have took it on the very next candle, and it would have went immediately against me, and I would have felt like an idiot for taking that trade. So I think trade 6, I realized my mistake before it got ugly, and I closed it out for a very small gain. Now after that, I was just kind of feeling uneasy about the market because I didn't really know what this false breakout would lead to. So I said, you know what, I'll call it a day. And it's interesting because we hit the bottom of the zone, pushed back up to the top, and had another false breakout. And you can't see it because this is where I took my screenshot for my session. But after this, prices shot back down to the bottom of the zone and came all the way back down to retest where I went long at trade number 1. So notice how we had 2 false breakouts, which were actually, if we look at it, connect the high for this swing and the high for this swing. This right here is a lower high in comparison to the false breakout that we had from earlier out of that zone right there. So I think that's very interesting. But overall today, I would say it was okay. It was slightly decent, but it's so many small details that I need to clean up because yes, I made profit, but nowhere close to what I think I should have been capable of making. And I say that because it was a lot of hesitation throughout today's session. I think that was a thing throughout this uptrend, which when I think about it is a very common theme and a strong trend, because when you look at a strong trend on the chart after the fact, you say, oh, okay, I could have went long right here and then just held it the whole time. But when you're in the midst of a trend, it's harder to trade than it looks. It's a lot of hesitation because you say, wow, this was a very strong push to the downside. Should I go long here even though it's touching the trend line? What about this bear swing that just happened? It's pretty much a continuous bear spike for 2 candles all the way back down. Do I really want to go long right there? So that was hesitation right there on my part. I should have took that trade. I hesitated. On trade 1, I should have went long 9 points earlier than where I went long at. I hesitated. I had a late entry, which led to a break even trade rather than a positive trade. On trade 2, I hesitated when prices went against me just by a couple of points. And then on trade 6, I hesitated when I thought about the initial short trade at 38 and then eventually ended up chasing it down to trade number 6. So yeah, even though I made profit, I really got to clean up these small details because it's the small little things that make a big difference over the long run. So going into today's back testing session, I want to focus on, yes, being patient enough to wait for my best setups, trading my best setups properly, but also being decisive and knowing exactly what I want to do when I come into the market. I have my game plan. I know exactly how I want to trade my setups. When I see what I like, I need to take it. No hesitation, no nothing. Is it a possibility that I take a loss on the trade that I take? Yeah. But if I believe in it, I'm willing to accept the risk that comes with the trade that I'm entering into. So I appreciate you guys for tuning in with me. It's been a good day. It's been a good week so far. It's day 14. We got one more day left this week on Friday. We want to close it out the right way. So let's have a good study session tonight and come back tomorrow recharged and ready to go. So I'll see you guys tomorrow, day 15, 9:30 a.m. sharp. And until then, take it easy.